The IRS has a mandatory schedule to extract money from your retirement accounts starting at age 73. Whether you need the money or not, financial advisors charging 1% per year cost the average $2 million retiree more than $400,000 over a 20-year retirement, not in fees. In lost compounding, 90% of the alternative investment products now being pitched to people at your wealth level underperformed a basic index fund over 15 years. And the most common response to all of this, from people who spent 30 years building to this point, is to keep doing exactly what got them here. That's the problem. So here's the question worth actually answering. At $2 million, what game are you playing? Because the game changed, and nobody mailed you the new rules. For your entire accumulation phase, every contribution, every buy and hold decision, every year you didn't panic sell, you were playing offense. Every dollar saved was a point on the scoreboard. The coaching you got from advisors and podcasts and personal finance content everywhere was offensive coaching. How to score more, how to accumulate faster, how to hold through downturns. And it worked. You're here at or approaching 2 million because you ran the offensive playbook well. But at $2 million, without announcement, the scoreboard flips. You're now playing defense. And the playbook that won you the first game, save more, optimize growth, chase returns, becomes catastrophically misapplied on a defensive field. Because defense involves entirely different threats. A mandatory government withdrawal schedule that starts at a specific age and cannot be delayed. Fee structures that compound against you, the same way good investments compound for you, and a specific timing problem in how market returns arrive that can devastate a portfolio at this scale in ways that simply do not apply during accumulation. The scoreboard flip, that's the frame for everything I'm going to walk you through today. Every trap I describe, every solution I offer, it all comes back to one thing: recognizing that you are playing defense now and learning what defense actually requires. Here's the map. 4 structural traps that catch people at the 2 million level completely off guard. The specific math on what each one actually costs in real dollars. A 4-lever framework, not a 20-step system, 4 levers that tells you exactly what the defensive playbook looks like. And a case study with specific numbers so you can see exactly how this plays out in a real scenario. I've got multiple hundreds of thousands of dollars invested. I spent over a decade running my own business surrounded by accountants and fiscal lawyers who showed me how money actually moves, and I have no interest in making the financial industry comfortable. Let's go. In a few minutes, I'm going to show you the specific tax mechanism that quietly costs people at this wealth level $300,000 to $400,000 over the course of a retirement, and why the fix requires doing something that your accumulation brain will read as a mistake. But first, here's why the advisory model is even more structurally broken than you probably assume. Because this is the problem that sits underneath all the other problems. There's a retired engineer named Gerald, 61 years old, Texas, $2.3 million, mostly in a traditional 401k, about $200,000 in a taxable brokerage account. Gerald did everything right. Max contributions for 30 consecutive years. Held through 2008 when his portfolio dropped 40% and he didn't sell a share. Same thing in 2020. Held diversified index funds and did not touch them. Gerald is genuinely the model of disciplined accumulation. Gerald also has a financial advisor. Standard arrangement, 1% of assets under management per year. On $2.3 million, that's $23,000 annually. Over 20 years at 6% base growth. That 1% annual fee, compared to a total market index fund costing 3 basis points, costs Gerald approximately $470,000 in lost compounding. I want to be precise here. That's not the fees themselves. That's what those fees cost in foregone compounding. The math of compounding at scale is what turns a small percentage into a life-changing number. When Gerald sat with his advisor post-retirement, the conversation was almost entirely about asset allocation. 60% equities, 40% bonds, some dividend tilt, international exposure, reasonable, standard. But here's what didn't come up in that meeting: the conversion window. The required minimum distribution clock ticking inside Gerald's 401k. The specific tax structure problem compounding in the background while everyone discussed which bond ETF to hold. The advisor wasn't negligent. He was reading from the accumulation manual on a defensive field. And here's why this happens structurally, not because advisors are bad people, but because the system creates a specific quiet conflict. An advisor charging assets under management fees has no financial incentive to recommend Roth conversions. Conversions reduce the pre-tax balance, which reduces the fee base. No incentive to recommend 3 basis point index funds that eliminate the rationale for active management. No incentive to simplify. In the AUM model, simplification is revenue reduction. This doesn't require anyone being dishonest. It's the math of the business model quietly shaping every conversation, even when no individual intends harm. And then, at 2 million, something else begins. The product pitches arrive. Private equity funds, real estate syndications, alternative investment vehicles with names long enough to fill a second business card. The pitch is always the same energy. This is what the ultra-wealthy actually do. Index funds are for people who don't have access to this level. That line is engineered specifically for the person who built $2 million, competitive, research-driven, allergic to missing something real. Here's what those pitches sound like from someone who has sat across from a few of them. The deck arrives. 12 to 15% projected IRR. A waterfall distribution chart, which is a real industry term for how private equity pays out returns, and I will let that name speak entirely for itself. 7-year lockup. Preferred return structure. Co-investment rates. Everything sounds sophisticated and exclusive. What doesn't lead the conversation? Your money is fully illiquid for the entire hold period, including if you have a medical emergency in year 4. The projected returns are pre-fee and pre-tax, and the promoter's management fee is largely insulated from whether your actual returns materialize. The S&P SPIVA report for 2023 found that over 15 years, more than 90% of actively managed funds underperformed their benchmark index. 90%. These alternative products typically charge 2% annually plus 20% of profits. You are paying, in most cases, a meaningful premium to underperform something costing 3 basis points and requiring no 45-page limited partnership agreement to understand. The scoreboard flipped. These products are selling you an exciting offensive play. You need defensive structure. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now, the most expensive structural problem at 2 million is not outside you. It's sitting inside your own accounts and ticking. And most people encounter it around age 73, when the window to fix it has been closed for nearly a decade. Patricia is a retired teacher. She hit just over $2 million at 65, all of it in a traditional IRA. Well-managed, good allocation, advisor-approved withdrawal plan, Social Security coming at 67. Patricia felt good about this plan. Solid. Nobody mentioned 73. In the United States, at age 73. And this moves to 75 in 2033 under secure. 2. The IRS requires you to take required minimum distributions from every pre-tax retirement account. You own traditional IRA, 401k, SEP IRA. The government gave you a tax deferral for decades. It now sets the collection schedule on its timetable, not yours. For Patricia, 2 million in a traditional IRA grown at 5% from 65 to 73 became approximately 2.9 million. Her first required minimum distribution, using the IRS Uniform Lifetime Table Factor of 26.5 for age 73, was approximately $109,000. She didn't need $109,000. Her lifestyle was already covered. But she had to take it. That forced income triggered a cascade. Up to 85% of Social Security benefits became taxable income once combined income crossed the threshold. Medicare's IRMA surcharge kicked in, adding hundreds of dollars per month to her Part B and Part D premiums. The net investment income tax at 3.8% applied on top of the rest. All of this is written in the public tax code. It's public record. It just requires reading the tax code. which is a document most people have a completely rational instinct to never open voluntarily. You think the problem at 2 million is investment performance. The actual problem is tax structure. The scoreboard flipped years before the required minimum distributions arrived, and nobody was running defensive plays. There is a window that addresses most of this. It is closing every year, you don't use it. From the moment you retire until age 73, before Social Security begins and before required minimum distributions kick in, your ordinary income may be very low. Your marginal federal tax rate during this window could be 12 or 22%. Every dollar you convert from a traditional IRA to a Roth IRA during this period is taxed at that lower rate. It then grows tax-free permanently. It passes to your heirs income tax-free. It never triggers required minimum distributions. And it permanently reduces the pre-tax account that would otherwise generate mandatory distributions you cannot control, cannot delay, and cannot refuse. This is the conversion window. It is the most underutilized opportunity in retirement planning at the 2 million level. The structural reason? Advisors on AUM fees are not financially incentivized to direct you toward it. And most retirees don't know it exists until they are already past it. Let me walk through the specific math with Mark. 62 years old, retired last year, 1.8 million in a traditional IRA, 200,000 in a taxable brokerage, Social Security of 30,000 per year at 67, annual spending $90,000 calculated from actual expenses, not estimated, no pension. The default advice Mark received: spend from the taxable brokerage first to preserve the IRA's tax-deferred growth, collect Social Security at 67, think about required minimum distributions when you get closer to 73. This is standard advice, not wrong for a $300,000 portfolio. Wrong manual on a defensive field at 1.8 million. Math without conversions: the IRA at 5% growth for 11 years reaches approximately 3.1 million at age 73. First, required minimum distribution, approximately $117,000. Add Social Security income of $30,000, most of which is now taxable. Mark is in the 22 to 24% federal bracket on most of his retirement income. The IRMA surcharge applies. His effective tax rate in retirement meaningfully exceeds what he paid during peak earning years, despite earning no salary. And this situation is locked in at 73. It cannot be meaningfully undone. Math with a conversion window. Mark converts $100,000 per year from 62 to 67, 5 years. Federal tax on those conversions in the 22% bracket, approximately $22,000 per year. Total proactive tax cost over 5 years, approximately $110,000. What that buys: the IRA at 73 is now roughly 2 million instead of 3.1 million. First, required minimum distribution, approximately 75,000. IRMA likely does not trigger at all. Social Security taxation is lower. $500,000 now sits in a Roth account, compounding tax-free for the rest of his life and passing to his heirs with no income tax liability. Estimated total tax savings over a 25-year retirement, compared to the default, $300,000 to $400,000. $110,000 paid proactively, $300,000 to $400,000 returned. This is not a gray area. It is a documented, legal, widely available strategy that the default financial advice does not lead with. The 4 levers that determine outcomes at the 2 million level are tax structure, conversion timing, sequence management, and behavioral discipline. Most financial planning at this wealth level addresses maybe one of them. All 4 interact. Optimizing one without the others leaves significant money on the table and, in some cases, makes one of the others worse. Gerald, our Texas engineer, started running the conversion math in late 2024. His advisor initially resisted, for the structural reason I already described. Gerald is an engineer. He built his own spreadsheet and ran the scenarios himself. He started converting $120,000 per year in early 2025, filling the 22% bracket without crossing into 24%. He lost 2 years of the window he didn't need to lose, but he's going to be fine. Stubbornness, it turns out, is occasionally a financial virtue. What it took, he had to override the default. He had to push against a system structurally not designed around his actual problem. That is what the scoreboard flip looks like when nobody around you has noticed it happened. Now stay with me here, because the third structural trap is the one that turns good planning into bad outcomes and has nothing to do with advisors or tax structure. It is purely about timing, sequence of returns risk. The phrase is academic. The effect at 2 million is not abstract at all. Two investors retire at 62. Both start with $2 million. Both earn the same average annual return over 20 years, 6%. Both spend $80,000 per year. The only difference? One gets significant market declines early and strong years late. The other gets strong years early and declines late. Same average return, same spending level, wildly different outcomes. William Benjamin documented this when he developed the 4% rule in 1994. The investor who hits a meaningful market decline in the first 5 years of retirement can run out of money a full decade before the investor who got identical 20-year averages but better early returns. The average does not protect you. The sequence does or does not. At $2 million, a 15% market decline is $300,000 in a single year. A 20% decline is $400,000. These are not paper losses you hold through the way you did during accumulation. These are base reductions in the account you are simultaneously withdrawing from to pay your actual bills. And if required, minimum distributions are also occurring, which you cannot delay, modify, or decline. You are forced to sell assets at a discount on a government schedule, permanently reducing the base available to recover. That is the mechanism, not the market decline itself. The forced selling during the decline, at scale, on a schedule you cannot control. The defense? 12 to 18 months of living expenses in short-term treasuries or high-yield savings, sitting outside your investment portfolio. Liquid, not invested for growth. When the market drops 20%, you pull from this buffer and do not touch equities. You replenish the buffer when markets recover. The opportunity cost, approximately 1 to 2% annually on the buffer amount versus long-term equity returns, is the insurance premium. For a retiree holding around $120,000 in this buffer at $90,000 per year spending, that's roughly $2,000 to $3,000 per year. A completely reasonable price for never having to sell your best long-term assets at the worst possible moment. You cannot build this buffer effectively after the market drops 20%. You would be selling equities at a loss to fund the buffer that was supposed to prevent selling equities at a loss. The time to build it is when markets are stable or rising, which is now. Now for the fourth trap. And this one doesn't have a product you can buy to solve it. A National Bureau of Economic Research analysis found that retirees with larger asset bases spend a smaller share of their portfolios each year than retirees with smaller ones. The people with the most money to spend are using the least of it proportionally, because you built $2 million by protecting every dollar for 30 years. That instinct, accumulate, preserve, defer, wait, is not a habit, it's an identity. And it becomes a liability the moment the game requires you to actually deploy what you built. The Alliance for Lifetime Income found that 46% of retirees report anxiety from spending their savings, regardless of portfolio size. Nearly half. 2 million does not resolve this anxiety. It changes the flavor of it. The fear shifts from, will I run out, to, what if I lose it? And both fears, unmanaged, produce the same outcome. Underspending during the years when you're healthy and capable, and scrambling later when health costs rise and flexibility is already reduced. Imagine a 71-year-old with $2.6 million spending $65,000 per year on a lifestyle that could comfortably absorb 90. The annual gap, $25,000 of life he's not living, is being preserved for a balance sheet that will look slightly better at the end of the year. He's healthy. He's mobile. The window for the things retirement was supposed to be for is open right now. His estate attorney nods along through the annual review. His kids are going to have a very interesting decade. That's the accumulation brain running the defensive playbook. It does not work. A Vanguard study from 2024 found that behavioral coaching, helping investors maintain structure, avoid panic decisions, resist chasing. Recent performance adds approximately 1.5% per year in net portfolio returns over time. Not from better stock selection, from better decisions. On $2 million at 6% base growth over 20 years, that 1.5% behavioral advantage compounds to a difference of approximately $550,000 from not messing up. From knowing which game you're playing and building systems that account for the way your brain is wired to play the wrong one. Here's the kicker that ties this entire video together. The same qualities that built your 2 million, the protection instinct, the discipline, the willingness to sacrifice now for later, become active liabilities in retirement if you don't consciously override them. The accumulation brain tells you every Roth conversion is a loss because you're paying taxes today. It tells you the cash buffer is wasted because it's not compounding in equities. It tells you spending your principal is losing ground. And if you let that brain run your defensive strategy, the other team, the IRS with its mandatory schedule, the fee structures, the sequence risk will score on you legally and reliably and completely within the rules every single year. Gerald is going to be fine because he overrode the default when the math made it obvious. Patricia paid expensive tuition at 73, which is a very expensive classroom. Mark has the information right now at 62 when the window is still open and all 4 levers are still available. Same $2 million milestone. 3 different outcomes. The scoreboard flipped for all of them. One of them understood what game they were actually playing. One more piece before the takeaways, because it matters at this wealth level, and most retirement planning stops short of it. The Boston College Center on Wealth and Philanthropy found that 70% of family wealth is gone by the 2nd generation. By the 3rd generation, that number approaches 90%. Not primarily because heirs are irresponsible, mostly because there's no framework. The assets transfer, the knowledge doesn't. A traditional IRA inherited by your children under Secure 2 must be emptied within 10 years, creating large, concentrated taxable income events during their likely peak earning years. A Roth IRA passes income tax-free. Same $2 million in your estate. Completely different outcome for your family based solely on which account was holding the money. Check your beneficiary designations. Review them every year. The person you listed when you opened your IRA in 2007 may still be the legal heir to your retirement savings. The system sends no reminders. You have to look. 3 takeaways specific to this situation. 1. Calculate your required minimum distribution base today. Take every dollar currently in pre-tax accounts. Apply 5% annual growth to age 73. Divide by 26.5. That's the IRS Uniform Lifetime Table Factor for age 73. The result is your first mandatory distribution. Add your expected Social Security income. If the combined total pushes you into a higher tax bracket than you're currently in, or triggers IRMA at $85,000 adjusted gross income for single filers, or $170,000 for married filers, you have a conversion opportunity available right now, not eventually, now. 2. Map your conversion window with your actual numbers, not hypothetical ones. Count the years from today to age 73. Calculate the dollar amount you can convert each year while remaining in your current federal tax bracket. For most people in the 12 or 22% brackets in early retirement, that annual room is meaningful, often between $50,000 and $150,000. Every year of inaction is a year of the window that cannot be recovered. Do not wait until 70 to have this conversation. 3. Build the sequence buffer before the market removes the option for you. 12 to 18 months of living expenses in short-term treasuries or a high-yield savings account, sitting outside your investment portfolio. Liquid, not invested for growth returns. If you waited to build this buffer until after a 20% market decline, you will absorb the losses it was built to prevent. The correct time to build it is when things are stable. That means now, lazy investing built more fortune than crypto memes. And boring, unglamorous scoreboard reading structure built more retirement security than any investment narrative you have ever been pitched. The scoreboard flipped. Now you know what game you're actually in.